Welcome to the show. Be the boss of your money. I'm Mitch Goldberg, and this is a show about taking control of your finances. This covers a lot of ground: borrowing, spending. We talk a lot about investing, the general economy. I feel that the more you know, the better your financial decisions could be. And I regurgitate a lot of information here, and not all of it is going to be useful to you today. And you don't have to remember everything everything that we talk about. You don't have to remember everything we talk about. But by having the awareness that I'm giving you here day in, day out, you'll be able to recall it. It'll come back to you when you need it. And at the right time, I believe you'll be able to make financial decisions that are better for you. I want to get rid of ad hoc, spur of the moment, impulse, and I want to make sure that you're making decisions that are thought out, that are planned. Doesn't mean this does not mean you're never going to make a financial mistake, but it means you'll have the awareness which will help you make fewer mistakes. And when you do make a mistake, you'll realize it sooner. You'll make a course correction. Not every financial decision can have the impact that you want or the result that you want. And you do have to take some risk. Should you buy the house? Should you rent? Should you buy the car? Should you lease the car? You can do all the research you want. Sometimes the decision would have been wrong, but at least you have the awareness. You'll know for next time. If you want to make every financial decision perfectly right, there's only one way to do that, and that's to never make a decision. But that's not real life. So we talk about real life. And one of the things that we're going to talk about today is just two quick things. A rough day for tech stocks. A lot of you are, how I don't know if there's really a kind way to say this, but a lot of you are Johnny. I'm just checking my controls. A lot of you are Johnny come lately to the big tech stocks. You saw the big run they had. You saw how much they went up in the last quarter of 2023. They've been hitting highs even yesterday. NVIDIA, Microsoft, Meta, Alphabet, they've all either at highs or near highs. Amazon. And Tesla was recently at an all-time high or close to its all-time high. And that stock has been absolutely crushed in the last month or so. And you're wondering, is this the start of a new corrective phase in the market? Are you going to sit there and worry that you should be taking profits in your big tech stocks or your other investments that have big exposure to technology? For example, the S&P 500 is about 30% tech, large cap tech stocks. So if we're going into a long, drawn out, knockdown, tough time for tech stocks, doesn't this affect basically all investors? I mean, I look at mutual funds and ETFs, and it's hard to find one without exposure to the big tech stocks, from Apple to NVIDIA, et cetera. Well, the problem is a down market in the beginning looks a lot like the beginning of a correction or worse, a bear market. I don't like to make hasty decisions. We spoke about this earlier in the week, that this is what I said to you right here. If you're in these tech stocks, they're up a lot for you. It might be a time for you to consider scaling back, taking some profits, selling a few shares. And I want you to make sure you're doing it right. Maybe you need a stock shouldn't be more than 5 or 10% of your portfolio. So you need to scale some back for that. Maybe 3% of your portfolio. Maybe just you want to take your portfolio, look at it in separate chunks. So I've got the mutual funds here. I've got the exchange traded funds here. I've got the treasury bonds or bond funds here. But the individual stock portion, let's say you have $1 million portfolio and you have $300,000 in individual stocks. Maybe you're just going to say if a stock is more than 10% of the 300,000, that's too much. Or maybe you say if it's more than 10% of the million, that's too much. The point is, if you've been doing this for 20, 30 years or more, and you don't have some kind of strategy or way to judge a sell, to make a sell decision, you're doing it wrong all these years, and I want to correct that. So that's what one of the things you need to do. So this is what I do for clients, and if you do need help with this, you are welcome to reach out to me and see if we're a good fit. And you could learn more about me at our website, clientfirststrategy.com. I've been doing this for over 30 years, and you know what? I'm hoping to be able to do this another 30 years. I like what I do. It's my living, but it's also my passion. And then the Fed punts. We'll talk about that in a moment. We'll go through a quick market update. So I will now roll the intro over 5 minutes into the show. Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg with Client First Strategy. You're watching my live stream, Be the Boss of Your Money. To learn more about me, to connect with me, check out our website, clientfirststrategy.com. Let's take a quick look at the market over here. And Dow had not a horrible day. I know the headlines are that the Dow is down over 300 points and finished near its low for the day, but keep in mind, we just broke 38,000 for the first time, and 300 points just ain't what it used to be. You know, this 300 points ain't your father's 300 points, okay? NASDAQ, that did have a tough day. A 2% plus down day on any benchmark, to me, is a lot. It definitely gets my attention, and I want to take a look at that. So 345 points on a NASDAQ, that is less than half the value of the 38,000 on the Dow. That's a big down day. S&P off 1.6%. That's also a pretty big down day. And we were just talking about 5,000 for the S&P 500. I see a lot of year-end targets around 5,200, 5,300. Gold up 5, oil down $2 the barrel. We are waiting to see what the United States response is to the attack on the military outpost in the northeast corner of Jordan. When it happens, we'll find out later in the day on a news brief. I'm sure it'll be something. If you recall, when I think it was 91, right? Was it 90 or 91? I think it was 91. We had the first Gulf War when Operation Desert Shield turned into Operation Desert Storm. Now, a friend of mine said, I remember we were all in the office when that happened. No, this happened at night. It was not during the day. If you say, I remember we were all at work, I mean, it was at night. It was like 6:30 at night. I was at work because I was working late. And it came across the ticker, and a few people were at work. We were all cheering. But if you recall, when that happened, President Bush, the first President Bush, George H. Bush, was at his home in Maine, in Kennebunkport, on a fishing boat. So people were surprised. So that's the idea, element of surprise. And it was just a very calm, cool, casual thing. We rolled in, we rolled out, we defeated Iraq, and that was it. So I think you'll probably get something like that with Biden as well. Not a situation room moment, just to throw people off, I guess. We'll see, but that's something that's happened in the past. So, Renee, thank you for joining me here. Renee, you're like my favorite viewer. Thank you so much. Great reminder at the intro, Mitch. Your short format and consistently helpful content keep me following. Also, you found a time of day that I seem to be able to connect with you live. Brilliant. Well, thank you. I experimented for years till I found that exact right time. No, I'm kidding. 4:30, 5 o'clock, it's kind of like my time, and it works for me. I used to be strict about 4:30, but it's really been tougher to do that. So thank you very much, Renee. And if you ever have any questions that you think I should talk about in the show, or you want to speak with me on a one-on-one basis, please reach out. I know we've spoken in the past before, and I appreciate it. We're friends on Facebook too, which is really cool. By the way, I'm on Facebook, I'm on LinkedIn, I'm on Instagram. Reach out. I'd be happy to connect. Okay. So that's all well and good, but this is the big news is the 10-year treasury yield okay, is right here, is down. But this is the news, okay? 3.91%. So let's take a look at the bond yields, all right? We stay at 5% at about the 6-month mark. So still demand for those. 1 year, 4.72%. 2 year, 4.2%. We go all the way to the 10-year, 3.9%. So we've seen the 10-year go back below 4%. Bond yields went up because why? So this is the story, what brings me to the Fed punts. All right, let's take a look at that. The Fed met today. You know, they had a 2-day meeting yesterday and today, and their meeting presser slash assessment, their slash assessment. The Fed met today and post meeting their assessment slash notes that they want to share with the public. Basically says we are not ready to cut rates just yet. We want to keep rates steady. Now, before the meeting, there was a 50% chance that the Fed would start cutting rates in March, and some investors are expecting 4 or more rate cuts this year. I've been on record for saying I think we get 3. I think that is making a little bit more sense now, but it doesn't really matter if it's 2, if it's 3, if it's 4, if it's 5. The important thing is the Fed appears to have stopped raising rates. They acknowledge that it takes a long time for rate hikes to work their way through the economy. So the last few rate hikes still haven't probably worked their way through the economy yet. Plus, the previous ones are already working into the economy. So it's just a general cost of credit, cost of money is up, and that typically slows down the economy. There are a number of other factors that could slow down the economy, the Fed policy being one of them. But it's one of the tools we have. They're using it. And they said, you know, they're concerned about cutting too soon and seeing a resurgence in inflation. So they really want to wait until it goes lower. It's not quite there yet. Now, one of the things that could get the Fed off its stuff to cut rates is the non-farm payroll figures on Friday. This is big. Every month we get the non-farm payroll figures. That's the most important economic stat of the month. And because it's every month, it's a fairly new stat. It's not like GDP, where by the time we get it, it's 4 months old already. Okay. So this is a pretty important number. And if the Fed could see some weakness in the labor stats, which so far they've been surprising to the upside, with the exception of the ADP private payrolls report today, but that's not really a great indicator of what the non-farm payroll figures is going to be. Well, if we get a weaker number than expected, that would add fuel to the argument that the Fed could start cutting before June. If not, then we'll look at the February report and the March report, and maybe we'll be talking about a June rate cut. All right. But either way, I think we're getting one. And the Fed is being cautious, and I actually think that's a good thing. We want to make sure inflation is down. And if you don't have the patience for it, well, if you're investing for the long term, waiting a few more months for a rate cut is really not that big a deal. The important thing is that the Fed stopped raising rates and they're communicating. There was a call from the left, from Elizabeth Warren, for the Fed to cut rates, and because it's hurting the housing market, hurting people, blah, blah, blah. I'm aware of that it's hurting. It's supposed to. Slowing down the economy could hurt people. But when we have full employment, people are spending money. Inflation is going down after laborers received pay raises. So the consumer is actually starting to look pretty strong right now. However, I don't like when politicians get involved with monetary policy. I didn't like it when Trump was browbeating our Fed Reserve Chairman, Jerome Powell, and I don't like it when Elizabeth Warren browbeats the Fed either. I think it's a terrible thing when politicians start to act on the Fed. The Fed is supposed to be an independent body, much like the Supreme Court. So those are the things that are going on, and that does it bear watching? Yes, it bears watching. Is anything going to change from that? No, I don't. I really don't think so. I'm not particularly worried about it. So that's what's going on with the Fed. The Fed punted, and they're going to wait. There's a few more Fed meetings before June. There's a few more non-farm payroll figures, inflation reports. We're going to take them one by one. In the meantime, we are about halfway through earnings season. It's been pretty good. I'll just show you a quick view of the tech stocks that got pounded today. These are the tech stocks on my watch list. You're welcome to follow them. I'm going to go from worst in terms of percentage losses to gains. But Google led the day down. Their cloud was really good, but their advertising, which was, they missed it by a few hundred million, but you're talking like $60 billion overall figure. So it was a tiny little miss. Nevertheless, the stock was up at its year high, and a little bit of profit taking comes in. Cisco is still right off its year high as well, so I'm not too worried about that. But tech stocks in general, we're taking it on the chin all day, and they're basically starting to give back what they've gained over the last week or so. All right, Shop was just higher. I mean, Microsoft's just at a year high now. It's a little under 400. Salesforce, Nvidia was 630, is now at 615. Listen, I remember that stock was recently, 180. I mean, what do you expect? You can't go up every day. But you have to know if these are up too much for you. And here's some that are up at the end. So you have to know, are these too much for you? And what are you doing with these? You probably bought them. They're easy to look. Stocks are easy to buy when they're going up and everybody's bullish on them. 99% of investors buy what they hear in the news. This is my own anecdotal thing. They buy what they see in the news or what looks good in the chart. They don't know how to sell. Selling is harder than buying. We're always taught to buy and hold or just buy. Nobody talks about selling. I'm not a big seller because I'm not a trader, and I have stocks in my clients' accounts for 15, 20 years plus. I'm not a trader. I'm a long-term holder. But there are times when you get older, your risk tolerance becomes shorter, your financial obligations become closer, your active income turns into passive income. And these are the times when you become more sensitive to the fluctuations in the stock market. And these also become the times when you really have to start thinking about selling because you're converting your investments into income. And that's a tricky part of life. But if you plan for it and make it a gradual glide path, it's going to be a lot easier for you. And that's something that, guess what? I can help you with that. So call me. Thanks so much, guys. Have a great day and talk to you. I'll be back Monday. All right. So unless something crazy happens, I'll see you Monday. Have a great day.